Hey guys, Ben Nash from Pivot Wealth, and today I'm pumped to be here with Harry Dell. Harry is a tax lawyer. He's a founder and director at Cadena Legal. Um, been working in tax for a bunch of years, including the infamous ATO, and he's recently started his business this year off the back of getting deep into the world of crypto, tax, and Web 3.0 and domination of TikTok. So I'm keen to pick Harry's brain on some of the things that he's been seeing, trends, and what people should be looking for to be smarter with tax, also to be a little bit smarter with crypto as well. The first thing I want to ask you about, though, is I saw this piece that you put out about bribes not being tax deductible. Are you absolutely sure that that's true?
Absolutely. There's actually two sections about bribes. One of them says bribes to public officials are not tax deductible, and the other one's just bribes generally. It specifically says you're not allowed to deduct bribes, unfortunately. So I hope that doesn't affect your tax position, mate.
And also that apparently the operating expenses of drug dealers are also not tax deductible, but their revenue is taxable. That's quite surprising. Seems unfair almost.
Well, yeah, it does, but there's actually a bit of history to that one, and this is my favorite tax case. It's called La Rosa, and the real quick version is that La Rosa deals in heroin, and he was dealing in it, making lots of money naturally, and then the police confiscated his big stash of heroin. And because he was under the trading stock rules, he was clearly running a business, based on the size and scale. He claimed a tax deduction for his heroin being seized. And the court said, well, he runs a business. There's nothing excluding it. And the ATO argued, no, public policy. And ATO lost. So they then went to government and said, please fix that. And then we have this section saying you can't deduct it. So someone had to go spoil the fun, didn't they?
There you go. They can move when they need to.
Mate,
right. I thought, what sort of trends are you seeing in the tax space at the moment? Obviously, coming up to the end of the financial year, ATO's got its hit list out. What are you seeing at your end?
I'm seeing a lot of people who haven't previously gotten any advice, desperately looking for an accountant or a lawyer, even financial planner. This month alone, being June and May, I guess, as well, it's sort of been unprecedented, the amount of people who think I'm an accountant, first of all. I'm not. And then I have to send them on. But even when I send them on, the accountants are at capacity as well. Everyone's wanting to get everything sorted now. People are looking for a lot of Band-Aid fixes because they've left it the whole year. And I actually had a guy today said, I've made $1 million trading NFTs. I want to reduce my tax. I want to do some structuring. And I kind of said, like, we probably should have had this conversation 12 months ago, maybe 6 months ago, when you started to make some money. Can't really change the past. It's called planning for a reason. You plan in the future. So people are getting these sort of rude shocks. They remember that tax exists around May, June each year. And they go, oh God, I've made all this money. And actually really sad on another note is we've had the Luna UST debacle. Just to get a little bit technical, if you staked your UST in the Luna ecosystem or something called Anchor Protocol, you'd get rewards, you'd get income. But your stake is a capital thing. And then when that went to zero, you have a capital loss. So there are a few people who've reached out to me and they said, hey, I've made all this income in the year, but then I've got this massive capital loss and you can't actually offset the two. So they're literally left holding the bag. The ATO will say, you've got to, you had all this income. And they, a lot of times say, I don't even have the capital left to cover that because their portfolio's dropped, 70%. There's a lot of that, which is really sad. And I think people are starting to realize there's problems in this system, especially when it comes to crypto assets, because I don't know any other industries where you get a 70% decline and it's kind of like just a different day of the week.
Totally. And the other place that I'm seeing something similar happening at the moment is we do a lot of work with tech professionals, and a lot of them have got this RSU income or discount from deferral scheme income. where they're getting shares that are vesting over time, and that all adds to their accessible income, regardless of whether they sell the shares or not. And a lot of the tech workers, they love the companies they work with, don't sometimes understand the concentration risk that they're facing from having all of their stock and wealth in with the company that they work in. But and also the fact that the tech market, sort of like the crypto market, has been going up reasonably for the last little while, not used to the declines. But they're seeing people that have had huge amounts of shares vest. They're getting battered with this RSU tax. They've got a big capital loss that they're sort of sitting on, and the two don't offset each other. So that seems pretty unfair. Where now we've got share prices that are worth less than the tax bill, and they're sort of chasing their tail and in a bit of a bind. Do you think I know that you do a lot of like a bit of work and see across a lot of the legislation and development there. Do you think there's anything that might change around that?
Not for a long time. So like, I guess stepping it back to, the 1980s, back then you only pay tax on your income. On capital, there was nothing. So everyone wanted to make everything capital gains. And since we had CGT come in, we've kind of got this two-tiered system where income is just, accessible, marginal rates, whatever. And then capital's got this different kind of treatment and different sort of rules. You've got trigger events and things like that. Which means that like a lot of what I do is essentially playing off those two regimes to go, well, this one want to be capital, this one want to be revenue, here's what we've got to do. But it goes wrong so often. So funnily enough, like tech companies appear to be correlated quite strongly with the crypto markets, which is, FANG and Atlassian, all those sorts of things. Like it's kind of like tech in one big bundle. But you're right, those deferred taxing points can bite pretty hard when people who worked in these companies sort of have probably the unreasonable expectation that they go up forever when nothing goes up forever. And we both know that. And they really get stung, and it's very hard to plan for that. There was actually a case, it was about 4 years ago, and this lady basically had this deferred option plan, deferred share scheme, whatever. And she got her shares because she could have opted to get them early under the scheme, and that would have been the taxing point. So she opted to get them early. The next week, company went into liquidation.
Oh, no.
So he paid tax at that top rate, and then it went pretty much to zero. The shareholders got nothing, and they went to court, to the AAT, and they said, well, she was induced, all sorts of things. And I remember the observation. They said, well, like it's really unfair. Understand that, but that's how it's designed. And these things don't change unless we make noise about it and get really upset about it. So like we've been successful in being upset enough about crypto where they're finally doing a board of tax review. But they're tinkering with the employee share scheme rules, and there is a lot of scope to bring it much closer to reality, because you probably come across this, Ben, like the tax outcomes don't actually match the financial outcomes exactly.
Totally.
Sometimes there's big changes like this, where it's like it's income, but it's in stuff. You can't sell the stuff sometimes, or the stuff lost 50% of its value.
Totally. Yeah. And unlisted companies where when you leave that company, sometimes you're required to exercise your options. That becomes a taxing point. The shares aren't liquid, so you can't sell them. If the shares are done well, it could be in the hundreds of thousands of dollars. You don't potentially have hundreds of thousands of dollars just lying around to pay a tax bill. And then you are riding the wave, as you say, hoping that the share price continues to go. But perhaps the fact that tech has just been booming for the last decade meant that there weren't enough people complaining about it. We'll see how far this slide keeps going, and maybe those numbers pile up that potentially something should get done, because it seems like, yes, I see that they're trying to protect things, but it's also, I don't think it's the intention to put people in a really difficult spot like that. But picking up on one of the things that you said earlier, I think I would agree completely that the best time to be planning with your tax is 1 July, not 30 June. 30 June gets most people thinking about planning with their tax. But one of the things that we talk about is that, you can't unwind things, as you say, that you need to be structured in the right way. And planning for the year ahead, even keeping the right records, that it's hard to dig those things around. You might think that you're getting these deductions, and I think the fact that a lot of things are over email and tech is making things easier, but also it is hard to pull together that digital shoebox at the end of the year, and that's where you can be running into trouble with the ATO. On top of that, what do you see as the key mistakes that people are making when it comes to their tax?
It comes to sort of pay as you earn employees. Well, start there. Like, the number one thing is not keeping records. So there was a very brief and unfortunate time in my career where I was actually auditing people's work-related expenses, and it's like little stuff. It's in the weeds stuff, but I'd call someone up and say, "Hey, how did you get to your $300 deduction?" Because people think it's a standard deduction. It's not. You've got to have some basis to claim it. Yes, you don't need receipts. And they say, "Oh, I'll just figure I can claim it." And it's like, well, that's the wrong answer. Now you're in trouble. And it's remarkably complex. I think over the last few years, there was a bit of a race to the bottom on tax accounting services for individuals. But I think people are pulling back from that and going, well, I don't want the $50 tax return anymore, because you can do that yourself on MyGov.
Yeah.
What you want is the advisory to go along with it, to say, well, yes, here's what you've got to keep if you're going to claim your car. Here's like the available methods. The $150 for laundry. Obviously you can't be getting detailed advice on your laundry deductions, but like, the accountant's got to know, and that's the service that you're paying for, is someone knowledgeable. And that knowledgeable person has to say, you need a basis. Where's the receipt, or where's the record, or where's something? And a bank account is not enough. Bank statement is not enough. The best tip that I've got, and this is something I do myself, is I use the ATO app for record keeping for my own personal tax return. It's actually really good. And you can link it directly to your accountant's software, so they can see all your expenses with all the receipts. Like, I take photos of my computer screen, it's not very techy, but like, it does the job.
Yeah, that's great. I didn't even know that they had an app like that.
They did. You find the ATO on the App Store. And you can log your business kilometers. It can do all sorts of stuff. Really underrated tool. So I think the ATO should be paying me out of their marketing budget at this point. But it is a good little app.
Great. Well, I'll have to check that out. But I think you need some sort of digital shoebox or something to be pulling things together, save you a lot of headaches at the end of the year, plus also help you know what your position is throughout the years, to know how much you should be focusing on your tax planning to get the right outcomes at the end of the year. Mad scramble in June, but really there's a lot of those things that could be happening much, much earlier than that. What would you say for business owners? And I know you do a bit of work with business owners and crypto businesses as well, but what would you say is the biggest mistake that they make when it comes to tax and tax planning?
The biggest mistake by far, this goes for just general business owners, is using company funds personally and not planning around that. So we've got something called Division 7A, which means that anything that comes out of a company will be couched as a dividend, therefore fully taxable. You can do things like put it on a complying loan agreement, things like that. But, in my time, both at the ATO and in private practice, the biggest mistake is people living off their company's card, and they might be doing well. And you just, you put the rent through it, you put the groceries through it, you put everything through it. Then at the end of the year, you go to the accountant and they're going to say, well, what's this? You've got to characterize every single transaction. And it's really poor tax hygiene. You mix things around, and then you've got to have loans flying around. And the more wealthy you get and you keep doing that, the more complex it's going to be, the more accounting fees that you'll pay, and the potential to pay more tax than you had to, because it will get you one way or the other. You can't use company funds without basically paying top-up tax on it, being the marginal rate between their corporate rate and your own rate. But yeah, people with their poor tax hygiene. I like how that sounds too. It's like, it's when I say that.
I see a lot of people in that Division 7A loan territory, and they speak to us like maybe 3 years in, where they've been spending money from the business, which is fine to do. Like, obviously, you work as a business owner, the money is yours, but because they've got you need to put the structured loan agreement into place and then pay that down over a period of time. Each year, it's sort of like the opposite of a share scheme that gets granted to you, that each year then you have to pay back more. And then when you end up having to pay like 100,000, 200,000, you have to draw that as taxable income, because you need to have legitimate, like on the books taxable income so that you can actually afford to pay your loan back. And then you sort of backed into a corner that if you're drawing a couple of $100,000 just to pay back your Div 7A loans, doesn't leave much room for one, you to be living, or two, to actually do anything from a wealth and tax planning perspective. And yeah, it's amazing that people don't think that there's some sort of unwinding, but it sort of also talks to the fact that sometimes I don't know what it is, that accountants don't call those things out early, or whoever's giving their tax advice. And then it's sort of one of these things that people could sometimes sort of skirt a little bit around the rules, or think that they might be able to do that. But especially as you say, as you're getting more and more wealthy, you've got more and more money, you're more likely to get in the spotlight, and the impact of having someone look at what you're doing is going to be even bigger. When you're wealthy as well, do you really want that stress of, being sweating that the ATO is going to come calling, and then you're going to end up in a really difficult situation? How do people know? Like, because I think that's the other part, that like business owners don't always know if the advice that they're getting is right or enough, and it is really hard to figure that out. Even for me, in looking at advice from a specialist, it's like, I understand tax, but I don't know enough to say, oh, that's covering everything, or it's not.
Yeah.
Like, how do people know if the advice and support that they're getting is good or not?
My favorite way to tell people that is, obviously you don't know what you don't know. And when you receive a complex piece of advice, whether it's from someone like yourself or someone like myself, if it's not in the document, you don't know what you're missing. And the best thing I've told people, and I think it's a very Australian thing, is to talk about it with your mates. If you're, focusing on your wealth and building your business, or, your employment, you should usually have friends that are the same boat, and you should be talking to them by saying, well, what sort of advice do you get? And I like it because it kind of gives legitimacy to the pub test of, if I tell people to do some bizarro offshore thing, they kind of know it smells bad. And I really have to go, well, here's really why that's right for you. And if I can't do that, then they're going to talk to their mates down at the pub and say, well, have you guys ever heard of this? And then they'll say, well, no, my guy says that's straight up tax avoidance. Like the clients don't know. But in fairness to the advisors, like especially the accounting advisors, and kind of circling back to before, is they will often only hear from the client around sort of May, June, July. And then they've already taken out 100 grand from the business, or they've already gone to a dodgy operator and they've set up a foundation in Seychelles, and, they don't get their crypto wallets. And then like they're kind of left like holding the bag, saying, well, like you've got a problem here. And they've got to have that hard discussion, and the client doesn't want to pay for that discussion, because you don't like being told you've got to pay a lot of money, especially when you made that mistake yourself. And it just becomes a prevention's better than a cure, as it always is. But yeah, you have to have faith in your advisors, and eventually you need multiple advisors, and that comes at a cost. So obviously, as your wealth grows, your first advisor, I tell people, should be an accountant. You should be getting an accountant first of all.
I'm offended. What do you mean?
Are you?
No,
accountant or financial planner, but they need a trusted advisor who can like look across their whole financial universe. Because I can't do that. I'm not going to sit with a client and meet with them, every year or every few months and check on what they're doing. Like I do one thing and strategize that and kind of hand it back to you, and you have to do it, which I quite like. But they need someone to be in control of their financial universe, because if they're in control of it without being taught along the way, they'll just make big mistakes. And I'm sure you've seen that time and time again. It's just education.
Absolutely. Yeah, I think I think it's actually even hard for accountants these days, with there being more sort of hard line with what is tax advice versus what is financial advice. That accountants sort of can see stuff, but because they're often what they're trying to do is reduce tax, which of course makes sense, but you've got to reduce tax and you've got to have a strategy that fits in with the lifestyle that you want or the wealth building strategy that you've got, not just what your next move's going to be, but what are the 2 moves beyond that, and making sure that it fits. Like, different entity structures, and if you're wanting to invest in property versus wanting to invest into dividend paying stocks, like it's going to change what the right strategy is in terms of how you're getting your money out of your business or entities and that sort of stuff as well. So sometimes, because what we do, obviously I'm totally biased because I do it day in and day out, but like, because we're mapping out like 5 years, 10 years, 15 years, and we've got the the private school fees and the holiday house and all of those other things that are in the plan, that you can go, okay, well, actually, this is what's left over. Yeah, this opportunity seems like this and this. Okay, let's tag in the tax specialist and then say, okay, well, based on this, what's the most effective way to get there? So I completely agree that you want someone that's across the breadth of stuff.
Yeah.
And whoever that is, I suppose it as long as it's someone, but they need to be able to see all the ins and outs, because that does make it does make a big difference to what makes sense, and it is going to be right. Yes. What would you say is the biggest opportunity for people to be saving tax? Maybe just sticking with the individuals initially.
Yeah. Well, the biggest opportunity is educating yourself. There are no silver bullets. In this country, we're obsessed with property for good reason. It's a secure asset, shown to go up, blah, blah, blah. People will sort of, what I'd say in crypto is they're going to ape into property. I know people who bought property in the last couple of months who regret it because they bought it before the market dipped sort of, 5-10%. And they're, kind of struggling with that mentally. But it's education from people like yourself. When they're your client, you go, well, here's the financial plan and here's why, which means, next year when they come to plan again or whenever that may be, they know why they've gone from A to B and then from B to C. But if you don't have that, if you're not thinking about, I need to keep my receipts, here's my property strategy, I'm going to pay off my own home faster because that's a risk-free return, a tax-free return I can get by paying off my mortgage. If you don't have all those pieces together, I knew you'd like that because I heard you say that once. If you don't have all those pieces together, you don't understand your own finances, and you're going to leave something on the table, whether it's investment returns or it's tax. Most likely it's both.
Yeah, totally. It's I think it's great to have great advice. It's great to have a great plan, but ultimately it's like all of this stuff, it's a muscle that you build over time. And at some point, like you need to learn more. I think of the clients that we work with over a long time, that in the early days, we're focusing really on the fundamentals and they're getting their head around it, but you build over time, and then we can focus on the next layer of stuff. And it just, yes, it leads to better results. And yes, we put it up for them on a silver platter, but they're empowered to actually do that. And I think back in the day, from what I hear, I think it was very much a trust thing to go, I trust this person, I trust that they're good, and I'm just going to do whatever they say. But I think people are really missing a trick when it comes to that. Certainly they're exposing themselves to a much higher chance of something going wrong because they haven't done things like talk about it with their mates down the pub and make sure that it makes sense, or they haven't built that muscle for themselves. But they're also not, there's no way that you're going to get the same level of confidence and peace of mind in what you're doing either.
That's right. Like your role, 20 years ago was about, picking the right managed funds and picking the right investments. And that's how you were measured on your success. But now you're moving away from that. And I think that's much better. It's actually a focus on educating the client to do it themselves. And you providing obviously the foundations and the tools that they need to do that, and the information that's current. But like, say 1 year, I lost a bit of money. I'm not going to kick down your door and say, what the hell, Ben? I'm going to say, well, that's part of the market risk. I understand that. Hopefully my portfolio is optimized. So if I had gains, on property that year and a loss on my share investments, I can at least offset them. That kind of means things are working properly. But if you're not educating yourself, if you're not talking about it, and you're just blindly trusting your professionals, like, we can't do everything. So if someone says, give me a tax efficient structure, like, I've got to ask you questions. I've had clients complain, say, I ask too many questions. And I go, like, I'm not asking these for fun. Like, I need to know this stuff to give you the right answer. Because if I assume stuff and I give you the wrong answer, who do you think you're going to sue? Me. And it's not even going to be right for you, because it's just not going to be appropriate. So when you have a professional, like, you invite them into your life in a large part. And a couple of times, tax is a surprisingly intimate topic in someone's life. Tax residency, like, where do your family live? Your insurances, all sorts of stuff comes up. I've had to, like, apologize to people and say, look, I know it feels like I'm prying into your life. You probably do the same, actually. You go, like, I need to know everything about you. I need to know about your illegitimate child. I need to know about, your offshore foundation in Switzerland. I need to know all that stuff to properly advise you on risk. And if I don't, you're just doing yourself a disservice. So it's trusting professionals and giving them what they need to do what they need for you, not just saying, here it is.
Totally. And I think that there's a lot of different ways generally to be right as well. And a lot of times, especially when it gets to the more complex ones, it partly comes down to preferences and your personal, wants and how you feel about these things. So you need to unpack that in order to get there and make sure that you're making the right, choices or exploring the right pathways as well.
Absolutely.
Tell me, where do you see people going wrong with crypto tax?
So crypto tax is, when I mentioned education before, this is a big area where people should look to educate themselves if they invest, because it's probably 3 or 4 times a week I have a conversation with a client saying, hey, crypto is taxable, or exchanging one coin or token for another is a taxable event. And a lot of the time their mind starts melting because I think, oh God, what have I done? But if you sort of step back, you go, it's no different than any other asset class. If I was swapping my BHP shares for CBA shares, that's as much a taxable event if I swap Bitcoin for Ethereum. At that level, people don't appreciate the complexity that they'll get themselves in very quickly by just transacting quite a lot. And then when they start going to decentralized finance or DeFi, things kind of go to another level when you start staking and bridging and wrapping and loaning and all sorts of stuff. You need professionals that speak your language, particularly a tax professional. So a lot of my work is applying the same tax concepts as you do to property, shares, businesses, but I understand what you're doing in crypto. I go, yes, I understand this ecosystem you're in. I understand this protocol. I understand the terminology that you're using, so I can properly advise you. And, I don't want to spoil my own party, but any professional can do that as long as they learn it. It's not, I haven't learned extra tax law because it's the same tax law. It's just like, I know what a rug pull is, and, I know how NFTs generally work and all sorts of stuff. But if people bury their head in the sand, and don't talk to any advisor, is when they're going to, wake up on 30 June, go lodge their tax return and know $500,000 that they weren't expecting. That happens. That's going to happen quite a bit in July. And we've now got a relatively active ATO in debt collection. So people should be worried. Last couple of years have been a bit too easy on that front.
Yeah.
ATO's a bit thirsty.
I think as well that a lot of people, there's probably legitimate confusion that people don't understand, like you say, that swapping one thing for another thing or doing different things has tax implications. I speak to people that are often confused and think that that because they put money into an exchange and then they're transacting within an exchange, that it's only really when they take the money out that they see that as the event. But obviously that's not the case. But then I think,
doesn't it? Like, you go, well, I haven't made any money yet, but it's just like with the employee share scheme stuff before. It's still has implications.
Or my Betfair account. It's almost identical. It's like you put the money in, waiting for the money to come out. The capital gains, it just doesn't happen. So, but I think that also that probably the confusion, not confusion, but the fact that people think that because crypto is like anonymous currency, that there's potentially like they can skirt around some of the rules that are there as well. And I know that the ATO and legislators are still catching up to a degree, and I think it's going to take some catching up to get everywhere. But the thing is, this is like internet money, and I think like, yeah, maybe if you're a super hacker or something, that you might be able to mask things for a bit, but for most people, that those and if not all people, those things will come back. Like the ATO will figure out how it works at some point. These companies will have to report, and then you're going to be the one that's holding on and you know, in the firing line potentially. And if that comes at the wrong time in your life and you've made decisions based on what you think your position is, you're potentially into some serious trouble. What are your thoughts around ATO and getting up to speed around tech and tracking around this stuff?
They'll get there. And what people will think when I say that is like, okay, maybe we're safe for now. But you're not, because number one, we've got the data matching program that goes back to 2015, which is basically when people started making money in crypto. The exchanges don't care about your data. The ATO says, can I have data on this person? They go, sure. They don't care. They have to provide it by law anyway. They're not going to, you know, go to war and protect you for it. That's not what they do. Once the ATO's got that data and they can say, hey, you've been sending, you know, Ethereum across to this wallet quite regularly, we're going to assume that wallet's yours. And once you go onto the blockchain, it's one big, massive accounting ledger.
Yeah.
Forever. Like, if people think it's anonymous without taking very special actions, I think they're going to be really surprised. Look, there are ways that you can mask yourself, but if you can also track, you go, hey, your wallet has used one of these privacy coins or privacy protocols, that's very suspicious and we don't like that. I think the ATO will get very upset. So there's no point really just avoiding it like that. It's a very poor way of avoiding tax. There are much better ways of avoiding tax, which I won't share today. But just not putting it on your tax return is very poor form. The ATO has unlimited amount of time to go and amend it, and they can tack on a 90% penalty if they really felt like it.
And I think, again, like if people they think that they've got more money than they do have, then they can make decisions based on that and potentially run into some trouble. So I think it makes sense to do the right thing. And yeah, understand, know what your position is, not have to have that thought hanging over your head. But Harry, thank you so much for sharing your insights. I could honestly talk about this all day, and I feel like I'm probably going to have to get you back to do this again. But yeah, so much good stuff there. For people listening in that are keen to learn more about what you do, what's the best way for them to learn and reach out?
Best way to reach me is my website, which is cadenalegal.com.au. You can also follow me on TikTok and ask me questions. If you're lucky, I might even make a video just for you if you ask me a good question. I run a Discord server as well with almost 2,000 people in it, where we purely focus on crypto and crypto tax issues. I'm kind of on every platform. I'm on LinkedIn. I'm on Telegram. I'm on Instagram. I'm on Facebook. Like, it's kind of hard not to find me if you really wanted to. But yeah, I'm always up for a chat. Send me a message. But yeah, it's about being accessible to people. You know, I don't try and gatekeep myself. I want to be out there.
Nice. Not only are you everywhere, you're actually on TikTok about 57 times. So, you know, just think
yes.
people are confused.
Perhaps being everywhere is not a good thing. So, you know, you can kind of class it as spam if you want, but no, look, it's information that is normally gatekept. So I just like providing it.
Awesome, man. Well, I love watching them. So keep up the good work. Thank you again for sharing your insights, and we'll catch you on the next one.
Absolutely. Thanks, Ben, for having me on.
All good, man.